Hello everybody, this is our first project of the Stochastic Processes course in which we are going to value a European type call option. We are
Daphne,
Itzel.
Uriel.
and Leopoldo.
a financial option is a bilateral contract of sale. There are two types. The call option gives the buyer the right to buy and the seller the obligation to sell the underlying asset at a price previously agreed, known as exercise price or strike price. And the put option gives the buyer the right to sell and the seller the obligation to buy at the exercise price. For this, the buyer of the option must pay at the beginning of the operation an amount of money, better known as the premium, to the seller, who in this way will be obliged to respect the contract in case the buyer decides to exercise his acquired rights. A European option is a version of an option contract that limits execution to its expiration date. In other words, if the underlying security, such as a share, has moved in price, an investor will not be able to exercise the option early and receive or sell the shares. Instead, the buying or selling action will only take place on the option's expiration date.
Another version of the options contract is the American option, which can be exercised between the execution and the expiration date. The names of these two versions should not be confused with the hierarchical location. The name only means the right of execution. The binomial model is a discrete time model where we assume that throughout the life of the option, the underlying price experiences a certain number of upward and downward movements. In order to find the fair price, we compute an algorithm. First, we define each of the variables that we're going to use: the stock price at time 0, the strike price, the time horizon, the risk-free rate, volatility, and number of intervals. We have that the probability of an increment in the stock price is 1/2.
Then we define the variables of the algorithm. The first variable we define is delta t as the time horizon divided by the number of intervals. The up-step size will be defined as exponential of sigma multiplied by square root of delta t plus r, that is the risk-free rate, minus 1/2 multiplied by sigma squared multiplied by delta t, and the downstep as exponential of minus sigma multiplied by square root of delta t plus r minus 1/2 multiplied by sigma squared, and that multiplied by delta t as well. The first cycle we create is a vector that contains the maximum between 0 and the stock price, considering the up and down movements, subtracting the strike price. Then, to get to the fair price, we use another variable and another cycle, in which we multiply the probability of decreasing by the first I entries of the vector that contains the maximum obtained in the previous cycle and add it to the probability of an increment times the same vector but from entries 1 to I plus 1. By repeating this m times, the return value will be the one saved in this vector, getting as a result a fair price of 31,955 for this European call.
We show that the binomial method is evidence of the applications of stochastic processes in real life and in the financial world. In our research, we found that this type of method is great for American type options, but for European options, it may be faster to use Black-Scholes method.